What's up, everybody? This is Sunko, the Korean bro. Today is 2023, January 24th. Let's see what we have, okay? What the smartest investors know about Upstart stock? Kathy Wood is trouncing the market so far in 2023, mainly due to these three stocks. Five takeaways from Netflix earnings. This indicator suggests recession is coming. Here's how to insulate your portfolio. Mm. Nasdaq bear market, one incredible growth stock down 82% to bad like there's no tomorrow. Mm. Um, could price cuts actually be a genius move for Tesla? Three under the radar stocks with 590% to 772% upside in 2023. Um, 48.8% of Kathy Wood portfolio is in these seven stocks. How big tech layoff signs of trouble in the housing market. Three tech stocks that never plan to sell. Smarter stocks about fat induced bear market. Okay. First things first. Okay. What do smartest investors know about Upstart stock? Upstart stock was crushed over the past year. Rising interest rates are preventing lenders from issuing new loans and consumers from taking new loans. It wasted a lot of money on buybacks over the past year, but insiders are warming up to stock again as the bears get greedy. Upstart stock was crushed over the past year. Okay. Crushed over the past year. Upstart stock was crushed over the past year, preventing lenders from issuing new loans and consumers from taking new loans. Okay. The online lending platform faces a lot of near-term challenges. Hmm. Online lending platform. Okay, stock closed at its all-time high of $309 on October 15, 2021. At that time, investors investors were impressed by the AI-powered and lending platform's ability to help lenders approve loans with non-traditional data like a person's education, GPA, standardized test scores, hmm, and work history. Its revenue surged 264% in 2021, as that disruptive approach enabled lenders to reach a broader range of customers with limited credit histories. So there's like a limited info, but then its AI a platform uh, enables uh, um, certain kind of ways to let a lot of people borrow money, right? But today, Upstart stock trades at about $18. Its shares plummeted as inflation, rising interest rates, and other macro headwinds caused lending partners to provide fewer loans. At the same time, rising interest rates caused consumers to take out fewer loans. Mm. But today, Upstart stock trades at about $18. Its shares plummeted as inflation, rising interest rates, and other macro headwinds caused lending partners to provide fewer loans. So, because its partners are lending fewer loans, they got no option. They got limited sources to provide. Right. At the same time, rising interest rates cause consumers to take out fewer loans. Rising interest rates. Cause consumers to take out fewer loans. Okay, rising interest rates and like its partners, um, mm, they're passive, right? Mm. Provide fewer loans, um, willing to have fewer loans. Customers willing to take fewer loans, and its partners providing fewer loans, right? Hmm. That's why analysts expect offshore revenue to decline 2% in 2022 and drop around 11% in 2023. That slowed down, along with its lack of profits on a generally accepted accounting principles basis, mm, caused offshore to what is it? Lose its luster. But today, let's focus on three lesser known facts about offshore and how they might impact stock in 2023 and beyond. It's been buying back its own shares. Okay. Last February, offshore launched a $400 million buyback plan. Okay. That decision was baffling because its revenue growth was cooling off and its bottom line was turning red. In the first 9 months of 2022, offshore racked up a net loss of $53.4 million compared to a net profit of $76.5 million a year earlier. However, CFO Jen J. Data insisted those buybacks would enable offshore to take advantage of attractive buying conditions in its own stock. And it repurchased $150 million in shares in the first 9 months of 2022. Unfortunately, those buybacks were poorly timed. Offshore stock has declined more than 80% since it initiated a buyback plan. Okay. Offshore likely bought back shares to offset the dilution from its own stock-based compensation and secondary stock offerings in 2021. Its buybacks reduced its number of weighted average shares by 1% year over year on a diluted basis in the first 9 months, but the same number of shares could be bought for less than $20 million a day. Reduced its number of weighted average shares by 1% year over year on a diluted basis in the first 9 months, but the same number of shares could be bought for less than $20 million today. Those wasteful buybacks suggest that offshore management severely underestimated the impact of rising interest rates on its business. There's still a heavily shorted stock. The bears have clearly profited from offshore decline over the past year, but they might be getting a bit too greedy. Nearly a third of offshore outstanding shares were being shorted as of December 29, so any news regarding more moderate rate hikes could drive its stock higher and spark a short squeeze. Warming up to stock again, okay? Offshore faced lots of near-term headwinds, but its insiders actually bought 19 times as many shares as they sold over the past 3 months. The ORS scooped up 24% more shares than they sold over the past 12 months. That warm insider sentiment, along with offshore's high short interest, along with offshore's high short interest and a potential stabilization interest rate, suggests it might have a shot at bouncing back over the next 12 months. But that's all speculation for now, since offshore stock could easily plunge lower if rising interest rates and other macro headwinds drive the global economy into a deep recession. Are the risks worth the potential rewards? Offshore might not be down for the count yet, but its prospects won't improve until the macroeconomic headwinds wane. It also faced a lot of questions regarding its decision to fund some loans off its own balance sheet, the low margins of its auto lending business, and the possibility that traditional credit scoring agencies like FICO launching similar AI-powered tools. So for now, I think it makes more sense to buy other beaten down growth stocks and betting on offshore likely recovery this year. This is the stock that I have to study as well. Offshore. Kathy Wood is trouncing the market so far in 2023, mainly due to these three stocks. Okay. Coinbase Global. It currently ranks as the eighth largest holding of the art innovation ETF. However, the crypto exchange operator has been by far Wood's biggest winner this year, with a gain of more than 50%. It's certainly too soon to say that happy days are here again for cryptocurrency stock. Yes. But Coinbase is enjoying a resurgence as several major cryptocurrencies have moved higher in recent weeks. To be sure, Coinbase still faces significant challenges. The company continues to post steep losses. It recently laid off 20% of its workforce. Wood, though, remains bullish about the stock and bought additional shares of 4DR Innovation ETF earlier this month. Exact Sciences. Roku is the Art Innovate ETF's fourth largest holding. The streaming platform stock made up 6.87% of the ETF's total portfolio. It has been a big winner for Wood so far in 2023 with a gain around 34%. Like most of the stocks in Wood's Flash ETF, Rogue performed dismally last year. Its shares plummeted 82% as the overall market declined, but the climate has improved somewhat. The new year, Roku also has made a couple of big announcements. On January 4th, the company revealed that it's launching its own line of smart TVs. Wow, really? The company revealed that it's launching its own line of smart TVs. Several analysts didn't like the move, but other investors seemed to approve. Okay. The next day, Roku started that its number of global accounts had topped 70 million for the first time ever. It's own line of smart TVs. It's own line of smart TVs. Okay. Roku might be making a genius move by launching its own smart TVs. Okay, best of the bunch. It's possible that all three of these stars could continue to help Wood but beat the market in the coming months. But which is the best of the bunch? My vote goes to Exact Sciences. Okay. Coinbase could roar back. However, I'm not convinced that the crypto market will ever return to its previous lofty heights. My take is that these are other stocks that provide more attractive risk reward propositions than Coinbase does. Hmm. Roku might be making a genius move by launching its own smart TVs. My concern, though, is that the company will now have to compete against the major TV manufacturers that have up till now helped it achieve success. There's an old saying about not biting the hand that feeds you. It seems to me that's what Roku is doing. I'd prefer it if Exact Sciences was already generating solid profits. Yeah, solid profits. 5 takeaways from Netflix's earnings. Okay. Big leadership changes should help retain top executive talent. Financials are improving as the business becomes increasingly profitable. Efforts to grow the subscriber base could result in lumpy growth throughout the year. New co-CEO. Okay. Reed Hastings is stepping down from his role as co-CEO after leading the company for 23 years. Greg Peters, the former head of product and chief operating officer, replaced Hastings, co-leading the business with Ted Sarandos. Sarandos was promoted to co-CEO in 2020 and still has the content business. Peters has been instrumental in standing up and rolling out Netflix's new ad-supported tier at 3/4 since management made a surprise announcement during its first quarter earnings call last year. He says investors shouldn't expect any big changes in how it leads the company compared to how things worked under Hastings. The three Peters, Sarandos, and Hastings have worked closely for a long time. The move should help keep Peters' talent and Netflix for some time. Okay. $3 billion in free cash flow this year. Management expect free cash flow to climb higher this year on the back of solid revenue growth. The company generated $1.6 billion in free cash flow in 2022. It expects to nearly double that amount in 2023, reaching $3 billion. Driving the free cash flow is the expectation for a re-acceleration in revenue growth. Management expects just 4% revenue growth in the first quarter. but that number should improve throughout the year. Increased operating margin outlook. Operating margin outlook. Like the rest of the streaming competition, Netflix looking to make its business more profitable. Operating margin outlook. Okay. Free cash flow this year. Okay. More cash flow. More cash flow. And a new CEO, a new co-CEO. Operating margin outlook. Account sharing crackdown could cause near-term pain. Netflix will start pushing more subscribers to stop sharing password later this quarter. Sharing crackdown could cause near-term pain. Near-term pain will be caused by account sharing crackdown. Account sharing crackdown. Okay. Management expect near-term pain as it faces some cancellations from crackdown based on its trials in Latin America. Some viewers will cancel, similar to what we see when we raise prices, Peter says on the earnings call. But then generally what happens is we'll see folks come on as new subscribers, essentially borrowers, creating their accounts or incremental monetization through the extra member. They'll happen shortly thereafter. That's partly the reason why Netflix expects low subscriber growth in the first quarter. Additionally, management expects a very different pattern for paid net ad growth in 2023 as a result, with the second quarter subscriber growth outpacing the first quarter. Advertising is going better than expected. Okay, account sharing crackdown, new CEO, increased operating margin outlook, and $3 billion in cash flow, free cash flow. Great. Advertising. Netflix stood up and launched an ad-supported tier in about 6 months. And while it may have experienced some bumps in its launch, overall it's going better than management hoped. Engagement is consistent with similar subscribers and ad-free plans. Most existing subscribers aren't trading down to the ad-supported plan either. What's more, the lower price point appears to be driving incremental subscriber growth. With a price point near the bottom of the industry, the ad-supported tier presents a lot of value for budget-conscious consumers. Ad-supported tier. Ad-supported tier. Okay, I don't know what ad-supported tier is, but I guess that it's something related to their business plan, and management is extremely optimistic about advertising plan. Okay. A great quarter and great outlook. Netflix heading into 2023 with great momentum. The stock could reward patient investors. While it may face a bumpy ride getting the advertising business off the ground and cracking down on password sharing, it appears to be moving toward its long-term goals of re-accelerating revenue, expanding its operating margin. The share buyback should add some support for its stock price as well, and cash flow will likely expand further in the years to come. Okay, cash flow, new CEO, advertising business plan, account crackdown,